Now, in the previous slide, I referred to that institution called the central bank. Now, the central bank is essentially, I'll just talk a little bit more about it now. The central bank essentially is an independent government institution that is responsible for undertaking policies to control the rate of price increases or the rate of inflation, as well as the supply of money that flows through a country. Now, it operates at arm's length from the government that's the government of the day, and so because of that, they're very independent. They are not, in theory, expected to be influenced by anybody working in the current government. The only way that the government can directly influence the central bank is by electing the head of the central bank or the governor of the central bank. So in Canada, the central bank, which is known as the Bank of Canada, and in the U.S. it is known as the Federal Reserve. I'll just write that down. Canada Bank of Canada. U.S. it's called the Federal Reserve. So that's a term you need to look out for when you're watching the news. So how does a central bank like the Bank of Canada or the Federal Reserve in the United States control inflation or the rate of price increases? How does it influence the external environment that businesses and companies operate? It can do so by essentially controlling the money supply or the rate of money and the amount of money that's flowing through a country, through its economy, and it has various policies at its disposal to do that. And what these policies essentially are called, and a fancy term for these policies is called monetary policy. And that's a term you're going to hear a lot too. So if we want to take this at the most simplistic level, if a central bank, let's say, for example, the Federal Reserve in the United States, wanted to create more economic activity, it wanted to increase the GDP, the amount of wealth that's being created in the country, it can institute policies that would result in increasing the money supply. In other words, putting more money in circulation and getting it into hands of businesses and banks to lend out and to invest, and creating new products and services. And ultimately, if it wanted to slow down the economy because they think inflation is too high and price increases are too high and they want to kind of stabilize things a bit, it can take money out of the system. It can institute policies that can remove money from the financial system and make it a little bit more difficult for companies to invest in developing products and services and hiring people and selling those products. It's essentially because of these tools that the central bank has. It's a big reason why the stock market and why, as investors, we need to really pay close attention to what central banks are doing and the policies that they're implementing, because these actions can have a really profound effect on the external environment that businesses operate, and ultimately are going to impact business decisions that companies are going to make and how they're allocating and investing their capital. And ultimately, it's going to impact the level of profits that the company can generate, and which will ultimately feed into stock prices. So stock market analysts and economists and all kinds of stock investing observers are always constantly, anytime somebody from a central bank is saying anything about anything, people are on it and they're basically analyzing every little word that's coming out of these places with a fine-tooth comb. And they're literally parsing every word and sentence for kind of clues on what's the central bank is thinking and what kind of policies it could be implementing in the future, because it's trying to get ahead of that thinking so they can position their investments and make their investment decisions accordingly. It's interesting, though, now where we've gotten to the point now where you can probably say that after a prime minister or a president of like the United States, probably the next most powerful person in those particular type of countries are really the governors of the central banks. So the governor of the Bank of Canada, the governor of the Federal Reserve, often have more ability to influence an economy directly than the people that have been elected into office.